It's Brian Preston, the Money Guy.
First question is from Chris Haddlesey. This is on YouTube. If I only have, this is a beautiful question because we had lunch with a dear friend of ours today, and we had this exact same question. If I only have 10% saved towards a down payment, but could get another 10% from my emergency fund, would it be better to do an 80-10-10 loan or use emergency cash and immediately get a HELOC? That's a great question, and there are a number of different variables that play into it. Here's the first of which I'm going to throw out there. You need to look at what the rate differential is. If you were to do an 80-20 or an 80-10-10, or borrow money from emergency reserves, take your emergency reserves down and put down true 80% and have a conventional mortgage, what is the interest rate differential going to be in that? Because sometimes, like I know right now, it might be like 3 7/8 for doing the piggyback, or you might get like 3.5 if you were able to do a true conventional. You have to kind of measure that. The other thing you have to measure is, what does taking your emergency reserves down, how lean does that take you? Because if it puts you in a really scary spot where you were like nil on cash, it may not be worth doing that, because it does take, if you did want to go out and do that refi, it's going to take 3, 4, 5 weeks to be able to do that home equity line. It's going to take 3, 4, 5 weeks to get that cash back out. And you don't know what's going to happen economically. You actually saw this where you used to think that you had home equity that wasn't actually home equity.
Yeah, I mean, there's definitely an adjustment market price. I know when I get asked about this, I always get I confess, I'm too transparent, I think, sometimes. It's because we have shows, there's so many financial people out there saying you can't buy a house unless you can put 20% down. And I'm like, that's great. After you're financially stable, you're probably in your 40s, you're loading up the 401k, you've got your automated savings. But the reality is, and I went around and proved this. I went around and asked everybody in the office, because we have quite a few staff, very successful, great decision makers. And I asked everybody, including Carol, who's on staff here, great planner, CPA. And I was like, did you put down 20% on your very first house purchase? I don't think we had. Carter might have been the exception, and I'm going to give him credit if he was one, but maybe he didn't. I don't know. He'll poke his head in and let us know otherwise. But I found that most of us, if we were confessional, on our very first house, only put down 5%.
Yeah, certainly not 20.
And the reason is because especially if you live in a fast-growing cost of living city, this is going to shock a lot of people, is because the houses are appreciating because it's leverage. Realize if you got at the average house in an area, because it's high cost of living, is $400,000, $500,000. If houses go up another 3% next year, think about that on a $500,000 house. They go up 3%. It's going to cost you now $515,000 to buy the same house. Did you even get to save that $15,000? I mean, so it's one of those things where on my third home, I did put down 20%. I'm also on track to pay this house off within 10 years. Mm-hmm. All the things you hear about from Everyday Millionaires and Dave Ramsey and them. But I just know how hard it is when you're 20-something year old or early 30s trying to buy that first house. You're looking at 20% and going, that is just crazy. I can't do it. How am I going to do that? How am I going to do my 401k? And then you couple that with the fact that when you're 20 years old, every dollar is worth $88. Mm-hmm. When you're 30 years old, every dollar is worth $23. Right. So there's huge growth potential for every dollar that you can invest between 20 and 40 years of age. If you're spending every dollar going to cash to come up with a 20% down payment, I'm not so sure I'd have done it that way. Yeah. I mean, it's just being confessional. And look, a lot of you guys go, because I see it, you write me emails and you're like, or you put in the comments that Dave is worth a gazillion dollars, so I'm going to do what he said. Yes, Dave is worth a gazillion dollars, and he's done it right. But that doesn't mean our method on how to maximize what's going on with your free matching contribution from your employer, doing Roth IRAs. And it's okay because you probably can afford the monthly payment of the house, because we are very conservative with 25% allocated toward housing. So there's still 75 left for retirement and other things. This works, and it's more realistic, because I think it's very hypocritical for me to tell you to put down 20% on your first house. You're saving like everything, you're giving it all you got, and then I look back and go, I didn't put down 20%. I'm a hypocrite. Yep. And that nobody around here has done that. And maybe I'm too passionate about that, but it's just I want to be honest with you guys. Be aspirational towards 20%, but it's real. I'm realistic in your 20s, early 30s. That is a pipe dream to put down 20%. I'm going to get in trouble for that comment, aren't I?
I love it, man. I can't wait to see the comments on that one.